Okay, welcome everybody. I know. Can I get what's the gentleman's name that just joined with the hat on?
Kevin?
Kevin?
Yeah, Kevin.
Kevin. Okay,
Yeah.
okay, cool. I'm trying to get the name because there's a little caption on my side that I can't see your name, but that's awesome. Kevin. Everybody's joining right now. Look at it.
Yep, Kevin and Veronica and Kareem just joined. And Amber is still on here.
Yes, I am.
Perfect. Nice. Hey, Kareem, how you doing, buddy?
I am doing all right, just busy.
Yeah. All right. Well, to be respectful of everybody's time, it is 5:31 on my clock. I think we're gonna go and push forward and get through this. I'm pretty sure we're gonna have a couple other participants join us here in the next 5 minutes or so. But again, like I said, in respect to everybody's time, we're gonna go and push through and get started. Again, here we go. This is module 3. This is our third session. So you guys are pretty much almost halfway through. Once the class is over today, you guys will be a majority of the way through this whole process. So again, we want to thank you for your time and dedication and hanging there with us and really being that train the trainer model and being the advocate for us and what we're trying to communicate to the general community as a whole. And we appreciate your importance in being here. So that being said, I'm going to try to make this as interactive as possible. I may call on you just to read a slide or two. There's not a whole bunch. This cash flow analysis slide, cash flow is not going to be as meaty as some of the other previous PowerPoints. So a little bit lighter on the reading. And hopefully we can open up for further discussion what that looks like. We usually finish with about a good 15 to 20 minutes to spare for any questions and answers. Again, I not the subject matter expert. I try my best to answer all the questions, but if there's things that you have a different perspective on or you've seen it played out differently, please feel free to voice your opinion and speak out and interject and have those questions answered and have that good dialogue back and forth, because our purpose is to have quality dialogue so we have a better understanding of the topics that we're trying to go over. So here we go. I'm going to get started. It's going to be cash flow. What is cash flow? In layman's terms, it's like how much money you have on hand. That is about it. You reach in your pocket, you dig out a couple of 20s, 5 and a 10, that's how much you have. So cash flow measures the amount of monetary assets coming into and going out of the business over a set period of time. It shows the financial health of the business by showing how much liquid cash a business has on hand. Okay, so think of it as what you have in your back pocket, what do you have at the safe at your home, and what do you have in your bank account that is readily accessible and you can grab and get it. A small business owner, the survival of your business depends on the way your money moves. Understanding how cash flows in and out of your business gives you the power to grow strategically. But once your cash flow dries up, it is tough to dig yourself out of the hole, and it inevitably impacts all aspects of your business. Amber, I'm going to call on you. Could you read the first bullet point for us, please? Amber, you there, Amber?
Hi, I'm sorry about that. I had to get getting the kiddos dinner together.
No worries.
Okay. Oh, okay. Hold on.
Okay.
Excuse me. As an entrepreneur, you'll inevitably have to manage cash flow using your accounting. Oh, stop. I'm sorry. Is it okay if someone else?
No worries. I got you. I'll cover you on this one. I'll get at somebody. So an entrepreneur, you'll inevitably have to manage cash flow using your accounting software. So it's important you understand what it is and how it impacts your business. Defining cash flow is simple. Cash flow represents the movement of money in and out of your business. Just like money goes in and out of your purse or in and out of your pockets, it's how you manage that process of what that looks like, right? So think of it this way. Your cash flow represents all the transactions in your business bank account. When you have more than enough money in your account to cover your bills, you have a positive cash flow, right? But when the cash flow flowing out of your business, i.e. expenses, exceeds the cash coming into your business, i.e. revenues and income, that's when you have a cash flow issue, or it's considered a negative cash flow. Again, you want to have more money coming in than able to cover your bills and still have money left over to operate your business. That is in a sense, that is your cash flow. Kareem, my man, I know you're there. Read me the first bullet point, the difference between profit and cash flow.
Because cash flow only represents the balance in your bank account, it's possible for your business to turn a profit and still have zero cash. For example, you might earn 30% profit on every product you sell, but if you have more expenses than income, you still have a negative cash flow.
Exactly. And it kind of like explains the previous point. If you have more money going out, that you have too many bills, then you might end up with a negative cash flow. So your business could, in this situation, your business could actually turn a profit of $20,000 a month, which is great. 1 month, but only $8,000 of that in cash flow because the rest is pending in accounts receivables. That is why profit and cash flow aren't interchangeable terms. So again, to reiterate, your business can make $20,000 and only see $8,000 or $10,000 of that money because you have other things that are pending, accounts receivable that you have to pay out. That's money going out of your business. So it's not always that first bottom line number that you see, oh, it's $20,000, I made $20,000. Well, $20,000 is not the true profit that you actually made. Once your bills are paid, the excess that's left over is actual profit for the business. Okay.
I'm sorry, can I ask a quick question?
Please go ahead.
So you said they're interchangeable, so cash flow is not necessarily profit and vice versa, I guess? I'm hearing you right?
Okay, so cash flow is basically a snapshot of how much money that is going in and out of your business, right? So in this example here, bullet point number 2, your business could earn a profit of $20,000 in 1 month, but only see $8,000 of that cash flow because the rest is pending in accounts receivable, meaning that you have other bills to pay. So you did a job, say you're a painter, right? And you painted 5 houses and you received $20,000 for painting 5 houses. But then you got payroll to cover. You got to pay for your painting supplies. You got to pay for the paint and everything else. And that's $10,000 for simple math. So out of that $20,000, $10,000 of that went to labor, supplies, materials, all the stuff that you need for the job. So in actuality, you only have $10,000. So that's your profit for that specific job. And in that sense, you'd have a positive cash flow. If you earn $20,000, let me flip it on you. If you earn $20,000, right, and you had an excessive amount of expenditures, say your labor was $15,000, your painting supplies was $5,000, and some other materials another $5,000, you'll probably end up having a negative cash flow of $5,000 because you had more money going out than coming into your business.
Okay.
That's a simple way of thinking about it, right?
Yes.
Okay.
Thank you.
You're welcome.
Upon further inspection, a bag of sample ballots. It was just complete nightmare.
Somebody has some background.
Sons tweeting out that the lines are having.
Who's that? Okay. All right. Thank you, Daniel. So cash flow. Cash flow is the lifeblood of your business. So it's important to keep it flowing unimpeded. Studies show that one of the top reasons most businesses fail is because they do not have enough cash on hand, which is true. Essentially, cash flow is what makes your business buzz, and the pace of cash flow is just as important as having cash flow at all. When you have enough money put aside, it's easier for you to pay your expenses as they come due. But when your cash only trickles in, that's when you can stumble into having cash flow or running into negative cash flow issues. Impediments for small businesses, such as change orders, change in prices of supplies, insurance, rental equipment, labor cost, prices of gasoline, etc. All these have a direct impact on the cash flow for your businesses, right? So back to our previous example of the painting company, right? They have 5 houses that are painting. They're expected to win to probably profit, out of $20,000 after everything's paid, they probably could profit $10,000. But within that time frame that they start the job and finish the job, gas prices can go up, labor costs could go up, insurance could hit the accounts, supplies and rental equipment could also go up. So you have to take those into account and consideration when you are working on those jobs, because you have to compensate for that fluctuation. So you always want to have a positive cash flow. So if in fact those issues come up, then you're able to subsidize that extra added expense that you weren't really expecting. So you always want to have that emergency money on hand just in case those unexpected come up. So cash flow for startups is critical. Again, when these small businesses start to open up a business, you kind of want to ask them, how much money do you have set aside for your business on this starting up this new business? If somebody says I have $100, you can do it with $100. I'm not saying you can't, but it's better to have at least a couple of dollars in the bank to say, all right, I'm willing to invest this much money to my business. Because the banks are going to look at that as well. They're going to look and say, how much are you going to put of your own money to this business in order for us to risk our money and to match that money for that business loan? So the more you have, the better off you are in the long run. So if you're thinking about starting a business or you recently launched a new one, you'll inevitably need to invest some cash in the early days to get set up. You might need to buy new equipment, pay for a website, or put down a deposit for a rental of an office space. That's why you shouldn't be alarmed if you see more money leave your business than come in, at least at the beginning stages. So when you start the business, a lot of businesses, when they first start off, you're going to kind of run a negative cash flow because you're capturing all those added expenses that it takes to open up a business. So to fund these expenses and still have some capital left over for when your business opens its doors, you'll need to understand how to manage and protect your cash flow, right? For starters, you may need to invest some of your own money to cover your startup costs, i.e., like I said earlier, equipment, supplies, rental, office space. For those who have a tight budget, you can also explore other financing options such as business loans, a line of credit, or small business grant to cover your startup cost. Okay, it's common for small business owners to rely on these kinds of funds to get them through the beginning process, basically. But that's why we go back to the personal finances and your assets, because the better you are with your credit score, your debt to income ratio, your FICA score like that, the better chance you have on getting a business loan for your business, or apply for a line of credit, or apply for that grant. So sometimes when your personal finances are not in the best shape, sometimes that has a direct impact with your business finances as well. And we'll cover a lot of this in session 5. We'll go a little bit more into detail on that as well. So small seasonal businesses and cash flow. From time to time, you're going to run into some businesses that are seasonal. Some of the smaller businesses make jewelry for Christmas. They do a lot of the baking for Christmas. Go ahead, Daniel.
Has anyone else seen in Park Hill? There is a house. Where is it? I want to say maybe 34th, 35th, where every Halloween they sell Halloween costumes, and it's their entire garage, and they're out there with all of their signs selling Halloween costumes. Have you seen it?
I haven't, but man, that sounds awesome.
No, I've never seen that.
Too much.
Yeah, that sounds really cool. Do you know the cross streets?
It's just right by the Dahlia Center, the health center.
Okay.
Well, to that point, I mean, Halloween is actually a seasonal business. They are specific. You'll see them go open up the big warehouses and some of the vacant Sears Roebuck stores over there, or some of the old Safeways that never made it, and they're just a vacant, building. They'll go in there and just rent that building for 2 months, and that's it. So that is a seasonal business. So you got to make, and they make 95% of the money within those 2 months, right? But the remainder 10 months, they don't hardly make a lot of money, so they have to balance that cash flow for the remainder of the year. Granted, they may make in 2 months, they probably will make $300,000, right? Because they do sell a lot of that before Halloween, and then after Halloween sales, they sell a lot of stuff. And I have friends that actually specifically go and buy the next day and buy all the best deals, all those animatronics and all that stuff for their decorations of their house. But these businesses, they are seasonal. They make a lot of money in a short period of time, but that money, you have to project that out for the long run. So if you're a seasonal business owner, strong cash flow management skills are even more paramount, because you'll see an influx of cash during a specific season and little to no cash the remaining months of the year. Learning cash flow management can help you keep your business finances in the black, even in your off season. Okay, everybody understands that concept, right? It's a seasonal business. It could be for Christmas, it could be for Thanksgiving, it could be for Valentine's Day, and Halloween is a great example of them. So you'll see these Halloween stores open up, and for 2 months, like, wow, that was a Halloween store. And it's no longer a Halloween store. It's just a vacant building. So those are considered seasonal businesses. And if you have a small business come to you, say, hey, I'm a seasonal business, you need to let them know that they need to have a good understanding of the cash flow management. If not, they might find themselves into a lot of trouble going forward. Okay. 3 simple steps to get you started on this. Put together a cash flow statement. A cash flow statement will show all your business transactions, both income and expenses. It is generally includes 3 sections: cash from operations, cash from financing, and cash from investing. That's pretty standard, right? Does everybody understand that? Operations, cash from financing, and cash from investing. That is pretty straightforward. Again, you want to be able to forecast your expenses, forecast your cash flow. So use your cash flow statement. You can see which month you'll likely feel the pinch in your cash flow. For example, if you're a construction company, we know May, June, July, August, September are going to be the heavy construction season. That's when they're framing, laying cement, they're doing structurals, they're building, they're going vertical because the weather's nice. They understand that. But come November-ish, December, January, February, snow here in Colorado, it impacts the construction industry heavily. So they're not framing as much, they're not pouring as much cement because the weather, things of that nature. So you have to plan for things like that. So once you identify those periods, you can create an expense forecast. Basically, you'll estimate your operational costs for those months, including your rent, payroll, and any other recurring monthly expenses to see how much you'll need on hand. While a cash flow statement allows you to observe the cash history of your business and analyze any patterns, an expense forecast helps you make an educated guess about your future business spending. Use your expense forecast, you'll know exactly how much to set aside for slower periods. Again, it's basically generalizing that, and it's really tough for businesses who are starting up, because when you're starting up your business, you don't have no past history to go off of. You don't have sales from 2016, 17, 18, so you can guesstimate, make an educated guess. Okay, in 2021, Q2, I'm going to be here with my business because I've seen the trends over the years that I'm typically profiting X amount of dollars in Q2. You can't do that with a small business. So it's even more important that you pay so close attention to your cash flow and try to really understand those patterns of your business and the buying habits of your customer so you could adapt accordingly. Okay. If you know that you're coming to the high season and you know that's when your customers are going to be spending a lot of money, that is great. But you also got to be able to predict the downtime and the downturn in the economy. Sometimes April 15th, people they file their taxes. Some people get a tax return and you'll see a boost in spending because people got their income tax back and they're going to buy furniture. They're going to buy their tires. They're going to do the addition to their house. They're going to lay that cement for the extra driveway space that they need. So you just got to be cognizant of the fact that where are you at in terms of your customers and the buying patterns of that. In a startup business, they may not have a historical trend, those historical numbers that they need. They just have to do a best guesstimate on that. My recommendation is to study their competition. If you do not have any historical numbers to base your cash flow on, try to research your competition, see exactly the highs and lows where they're at in terms of their selling. That is my single best advice, is have them do the research and understand the market and what's going on. Okay.
Danny,
What?
real quick, I just want to say that is a great piece of advice for all of the people on the call here as a general way of pretty much a suggestion that will always be in the best to support your network. Ask if someone's coming up to you and talking to you about their small business and they're having issues, regardless of whatever the issue is, you might want to just ask, what are your competitors doing? Just in general, that's a great piece of advice there, Danny.
Yeah, and it's critical. It can make or break a business if they don't have that historical pattern like I was talking about to go off on. You go off on a gut reaction, you make a decision based on your gut, that might not be the best for your business. You want to narrow it down, not to get into too much detail, but you want to keep that within 1 or 2 standard deviations of that making a decision. I mean, if you're on the basic standard deviation, you got the basic L, right? You got your bell curve like that. If you're clear out here on the outliers, on the flattened, when it starts flattening out, that's 3 standard deviations. You move closer to the hump, 2 standard deviations, and if you're right in the middle, you're within 1 standard deviation. That will help you make that educated decision. And I know it's a little bit more technical than you guys want to know, but when it comes down to it, that's where sometimes businesses have to really understand that concept going forward. But for you as the trainer models, you need to tell them just to have a good understanding of their cash flow, what's coming in, and use the scenario as, well, how much money do you have in your purse? How much money do you have in your wallet, right? How much out of that you're going to pull out? How much you're going to pull out of that wallet to pay your expenses for that month? Whatever's left over, that is your cash flow, okay? Minus all the bills and other things you have to pay. So in layman's terms, that's kind of the best way to explain it. So three simple steps to get you started.
Okay. Hey, Danny, quick question.
Go ahead.
So how would if you're a startup and you're potentially competing against other small businesses whose financial information isn't necessarily public, how do you get that How do you get that info? How do you find out what your competition is doing in terms of cash flow?
You really don't know their cash flow. You can't really get into their financials or tax or anything like that. I would sometimes it happens, you could blind call the company as a potential customer and talk to them, say, hey, I'm thinking about buying X amount of product they're selling and whatnot. And you can kind of grab some information based upon that phone call with the representative there. They'll kind of give you an insight. You can't disclose that, yeah, I'm your competition, I'm just really shopping you out and whatnot. But you got to sometimes go there and buy their product. You got to go look at their website. You got to go see if they're, if they have multiple logos on their website, because those are the customers that they serve. Okay. So if they have 25, 30 logos, that means they're probably doing pretty good, right? You can track, and it is out there if they won city work. So if it's construction related or it's actual went out to an official bid process and they filled out the RFP, they won the bid, that is public information. And you'll know exactly if they're a subcontractor, tier 1, tier 2, tier 3 sub on that contract, you'll have a ballpark how much that contract was worth. Because the general contractor will say the general contractor won a contract for $100 million, but then 25% of that contract would have to be mandated to small minority women-owned businesses. So you can come close to a guesstimate of how much it is. You're not going to get down to the penny of how much they actually won that contract for, but you have a general idea. And that is in the construction world or the world that when businesses have to bid for work, you can get it narrowed down. When it's retail and you're selling widgets, that's a little bit tougher. That's something that you have to secretly shop them. You can make phone calls, and just ask anybody that's in your network that may know the owner or something like that. It is my best way to do kind of like behind the scenes, get a better idea. But understanding the market, you can go to actually the library is a great resource. The Denver Public Library is a great resource for that because they actually do show trends. I think, and don't quote me on this, but I think they'll actually show percentages of sales of the general market. They may not show exactly dollar amount figures, but they can show how much of these retails, how much of the market they actually sold to. So there's a lot of resources at the Denver Public Library. My wife works for the Denver Public Library, so there is a center in DPL that you can go there. They can assign to you basically a statistician who will help you do market research on your competition. I know that because I did it myself, and they'll give you a laundry list of all these businesses of who sell widgets. And out of the 25, you can kind of see, they'll tell you how long they've been in business, where they're located at. You could actually go and see, if you really want to get into the meat and potatoes, you can get their address. You can look up their address. Are they renting that place? Are they buying the place? That's a good indication of the cash flow. If your competition has 5 buildings and they own them all, they're doing pretty good versus XYZ company and they're renting their business location, right? That's a big indication of how their cash flow is, right? How liquidable their company is and how many assets they have. So there's a multitude of ways to go around it. You may not get it down to the penny or the $100 marker, but you can get a general idea of what they're at and how they're operating. You can go drive by the location. If they have a beat up sign and, windows are cracked and their trucks look pretty rough, it's like, all right, they're kind of struggling with their cash flow because they're not investing that money back into the business. If their equipment's not up to par in terms of like working and broke down and stuff like that. So again, that is just a suggested avenue, but I would highly recommend any and all small businesses that are starting up, go to the Denver Public Library, ask for a statistician, and you get like, I think 2 hours a month, but it's on a limited basis. You can't go in there multiple times because they actually dedicate their time with you and they show you all the search engines that you go in there and find out information regarding your competition. And it is pretty insightful. You'll be surprised of how much information is actually out there. Or this is the great one. This is probably the best one ever. Right here. This is the Denver Business Journal Book of Lists. Has anybody seen this? This is basically the Bible of businesses here in Colorado.
Danny, your screen for me is it's frozen, so I can't see the book. But okay. I believe my university, they have like an online. Through their university, they have the what I think you're talking about, but like digital.
Yep. This book of list.
I can't see it either.
Okay. Could you guys see me though? Could you see me?
I don't see you. I just,
Yeah, your profile's frozen.
Okay, hold on.
Hey,
Yeah, I
Danny,
think
I see you just fine.
I
Can you
see you fine, Danny. I think there's something going on with Kareem and Brenda's
Okay.
setup.
Yeah, I can see you.
I'll post.
Okay, cool. Okay. So basically, now that I mean, this is good that we got off subject because the book of lists. So there is information to answer your question correctly, Kevin. You go to the Denver Business Journal. This book of lists does outline financials in this. It shows you the fastest growing companies, Denver, the largest technology employers in Denver. It shows you the marijuana companies. It shows you the minority owned businesses, and it shows you revenue. It shows you the address. It shows you the number of employees. So this book of list, which granted costs a couple $100 to get because you have to have a subscription to the Denver Business Journal. And at certain levels, you get it for free. If not, if you want to purchase this thing outright, it's like $250 to $300 by itself. But this book of list is golden. This has all the information you need in terms of industry. It breaks it down by attorneys, dealerships, everything. So even Denver cannabis companies breaks it down by cannabis companies. So if you're looking for more information, and you can go to this, you get this from the library, but you can't check it out. You can go look at it at the Denver Public Library. This is $300 worth of information. It comes out every single year. It's pretty accurate. So this is huge. Any discussion on that? So that's what I use. I compare and do my research. There you go. Thank you for putting that out there, Daniel. Denver Business Journal. So there is key information out there. You just got to dig through it and go get it. Granted, your small mom and pop may not make the book of list. These are for businesses that are generating significant revenue to make it. But you at least get a good indication on the industry as a whole in terms of where it's going and kind of pick up those patterns on what's going on. And then if you need additional help, you hire a business consultant and we come in and we peel multiple layers off the onion and get down to the core.
Now, how often is this offered, or is it like annually? Is it the beginning of the year?
Annually, it comes out. I think it just came out in February, March, April, May, June. I think it came out in August.
Oh, okay. Wow.
Yeah. So if you've never seen the book of lists, and if the small businesses have any questions, they want to do some market research, tell them to go to the Denver Public Library and check this out. Or get a subscription to DBJ and they'll get this. But this shows you everything. It shows you the number one banks in Colorado.
I never knew it existed. Thank you so much.
Yeah, this thing will tell you Wells Fargo made $31.98 billion. They own 22.42% of the market. They have 150 branches in Colorado, and the Denver area deposits is $24.4 billion. Denver market share, they own 24.96% of the market share. And it also gives you who their CEO is and their title. And sometimes it gives you their email address and telephone number. So the book of list, again, is golden. So any business that are starting up and they want to do market research, go to DPL, check out the Denver Public Library, get a statistician, and they'll help you do your research for you.
So through DPL is the only access to it?
Well, I'm saying Denver Public Library, you can go and you could check, you could look at the book. You can look at the book. If you actually want the book of list, you have to buy it from the Denver Business Journal. It's about $300 just for this book. It's
It'd be worth it.
Oh, it's golden. Are you kidding me? It's golden. I've been looking at the book of list for years. Since 2005, I've been looking at book of lists from there, and I get updates on what's going on and the next trends. And you'll see those companies still stay there. you'll see the top 5, top 10. They'll always be there. They'll interchange from second place to third place, fifth place to third place, and first to second, and vice versa. They'll fluctuate back and forth, but it tells you the revenue. So that is huge, huge, huge information. So going forward, staying on cue here, plan ahead. Whether you're a seasonal business owner or simply experience slow sales periods throughout the year, planning ahead can save you time and stress. Okay. Here's where your forecasting from the last step comes in. To prevent any problems before they crop up, take those anticipated payments for your slower seasons, figure out which payments you can and can't delay, and then set aside enough cash from the peak sale periods to cover all of your operating expenses during the off season. Also consider setting aside an extra cash buffer to cover any unexpected costs. Again, emergency funds. To help you accurately forecast your expenses and plan ahead, try creating a calendar for your operating expenses, right? Let's create a calendar. So if you know every single month you got to pay your supply company $200, you could project that out for the whole year and say, all right, I know on the 15th of every month, I got to pay my company, my painting supply company, $200 for supplies. So that is something like, wow, I have to have $200 on hand to pay my supply company, right? Same thing with your labor. You can project, all right, I have 5 guys on board, or 2 girls, 5 guys, 2 girls, whatever it is, and I pay them X amount of dollars an hour. They log 20 to 30 hours a week. You're going to have a general idea how much your labor is going to cost you. And then if you're renting a building, your rent's going to be $1,200 a month. You know it's not going to change. So you got to have $1,200 set aside every single month for the remaining of the year. You could project that out. Same thing with your electrical bill and your gas bill and your trash pickup at your place of business. Those are standard costs. You know what I'm saying? Those are fixed costs. Actually, they call them fixed costs. Those are fixed costs because you know exactly how much they're going to be, and they're not going to fluctuate by much. Maybe electrical bill, obviously in the winter, it might go up because you're going to use the heater more. You know, same thing in the summer. If it's 100-degree weeks and, you know, obviously your air conditioning is going to kick on, it's going to be a little bit more. But for the most part, you can get a readout. Even electrical company, the water company, they'll give you a history. They'll give you a history of how much they've been charging you over the year. They keep that on hand, and they have to give it to you. That's your information. So if you call up Excel Energy and say, hey, send me my average monthly cost for 2019, they will have your bill for you. They'll send it to you, and they'll send you a pie graph or a chart. And they'll tell you June, you spent a lot of, Excel Energy was really high because it was a hot month. July, same thing. And then it teetered down in October, November because it kind of cooled off. And then again, you spike again in December and January because it's the winter months and it's colder outside. So that's another way just to control your costs and have a better understanding of the future expenses you're going to be having.
How much I'm using on a monthly basis compared to my neighbors.
Yeah.
Hello?
Yeah, I'm here. I can hear you. Go ahead, Brenda.
I get a statement from Excel Energy that gives me every month how much I've used during the month compared to what my neighbors use.
There you go. Mm-hmm. There you go. That's good. So you understand, wow, am I leaving my water sprinkler on too long, or am I leaving the lights on too long? You know, you gotta understand, all right, well, I need to put them on a dimmer, or you need to put them on a counter. So when they, when dusk comes up, the lights kick on. When the sun rises, the lights kick off. There's simple ways to control your costs in terms of electricity. So, and Excel Energy, they'll be more than happy to share that with you. They're a monopoly within themselves, so they're going to get their money no matter what. But if you ask them for energy saving ideas, they'll try to give you the best information they can to help you have your home or your business more energy efficient. Okay. So some of the do's and don'ts. Whether you're an established business or a startup, hire an accountant or a bookkeeper might not be financially feasible for you at the beginning of your business. Nobody has that extra money to pay for an accountant. Fortunately, when it comes to calculating cash flow, you don't need either one. And you probably don't even need a calculator. You just have a basic understanding of what's going on. To start, all you need is a firm grasp of a few basic terms like accounts receivable and accounts payable, which we covered in the last module. And once you nail those, you can begin tracking your cash flow. Okay. Using tools like free accounting software, you can track your cash flow automatically. So there is some free accounting software out there that you could implement to your business to help you keep track of your cash flow. Using cash flow statements shouldn't be confused with income statements or balance sheets. Each of these are distinct from one another and they serve different purposes. And we covered that in module 2. Okay, so those are some of the do's and don'ts. And a takeaway here is cash flow statements show how cash is moving into and out of your business. Typically, these statements break down cash flow activity into 3 different segments for easier tracking: operating flow, investing flow, and financing flow. So that is pretty much what cash flow is in layman's terms, the best way I can explain it to you guys and gals. I'm pretty sure small businesses, you may get some questions from time to time about cash flow and what that looks like. Again, the basic scenario that I gave you initially: how much money is coming into your wallet in your purse, and how much money is going out of your purse, and how much money is going out of your wallet. And at a snapshot, that is your cash flow. If you have more money going out than coming in, you have negative cash flow. If you have more money coming in than going out, you have a positive cash flow. So we have about 15 minutes left for questions and answers and any other discussions. If anybody else has any examples they would like to share or bring up or any questions, now's the time to do it.
Hey, Danny, just one other question. So as a new startup business is trying to manage their cash flow, how do they think about paying themselves?
That is a very good question, Kevin. And a lot of the times, and what I've seen in the past, is sometimes these business owners, they work for free. They end up working for free, not even paying themselves a single dime, because they're more so concerned about paying their employees, keeping the lights on the business and whatnot, But at some point in time, that sweat equity can only go so far that you actually have to say, wait a minute, let me set aside X amount of dollars for myself so I can pay myself a couple of dollars. So that is something that you want to take in consideration. Usually year 1 and year 2 are tough. They're pretty tough. Sometimes, small business owners don't make a heck of a lot of money in year 1 and 2 because they, like we previously talked about, they have more expenses going out than they do coming in. Rent, employees, equipment, maintenance on trucks, a lot of those things eat up that excess cash flow that could be your salary. But I would highly recommend that you inform those small business owners that they have to put a certain value on them and a certain value on their time. And it's either $20 an hour, $50 an hour, or $150 an hour. Whatever that dollar amount is, they have to assign that to themselves and make sure they get compensated back from the company, because people cannot continue to work within a company and not get compensated for their time. So a lot of that goes into smart accounting. If you have a smart CPA, like myself, my business, I own Apex Business Consulting, and Apex is a consulting firm which makes X amount of dollars a year, and out of that money that Apex makes, I pay myself a salary out of that, right? And you can kind of control the narrative on that and how much you decide to pay yourself. $20,000, $50,000, whatever that may be. Obviously, when the company makes more money, you could You can basically justify paying yourself more money to yourself, but you have to make that fine decision, right? Do I want to pay myself that money, or do I want to reinvest that money into the business? But you still got to be able to cover your minimal expenses. You cannot be falling behind on your personal expenses, rent, light, electricity, car payments, everything else, because that's going to have a ripple effect on your business credit as well. Because if you start falling behind on your personal account and credit, it's going to jeopardize your overall well-being. So again, you got to find that fine balance. But what I would recommend, Kevin, is that they take in consideration how much are they worth in the business, and they have to assign a dollar amount to how much time they put into the business and try to pay themselves some money. Because if they're not being able to pay themselves any money, they may need to figure out on a new path of earning income, and that might be going back to the general market and getting a job, because small business ownership is not for everybody. It's not easy to do. And again, I think I said this in the last couple of presentations, it takes a lot of blood, sweat, and tears to be a small business owner.
Well, I see that with the pastors and churches, some of them, and what they do is they don't accept the salary at first and to pay the expenses of the church, but they have this big annual anniversary where they get so much money for that from the people. But for a couple years they won't accept a salary, and that's to build their church, up. So, and the way that they do get something is when they have this big anniversary, the pastor's anniversary, and he get all this money. I've seen that with several churches.
Yeah, I mean, churches operate in a different manner. Their financials, their books are much different than your typical small business, because I know some of those churches are tax exempt, and they do get additional money. So it's hard to really um, compare a small business to a church, because their financial structure, the financial model is much different than it is for a small business. But yeah, you're right. They do that. They'll forego their salary for a few months, and then right at the end of the year, right around Christmas time, they're like, all right, the church is the one is having their big old extravaganza, whatever that may be, and that's their biggest fundraiser of the year. And then they added that big pile of money they pull out money for their salary for the year. So yeah, so it does happen. Any other insights, questions, comments, concerns, scenarios, situations that you guys experienced?
I was just gonna say, you're really right about how it's so much more difficult for small business owners because, like I took a class last semester or quarter or whatever, and the section of it was cash flows. But when you're talking about like big corporations, it's perfectly normal for the most part. I mean, sometimes it can be a sign, but you can look at a company and they can have negative cash flows like pretty consecutively, and it's just about what you expect them to do in the future and turning that around. And that's not really something you can do with a small business. Like you can't just like have consistently negative cash flows and then be like, oh, I'm good, I'm fine, whatever. Because it's just you don't have that capital, you don't have that level, like that magnitude of capital. And so, I think for smaller businesses, like just the idea of cash flows, you have to look at it in a very, like, what's the word? Like very just plain kind of sense, where it's just like I said, like, okay, what's in my wallet, what's going in and out, and then even on a mathematical level, cash flow, if you're getting an increase in accounts receivables, that's a decrease in your cash flow, because that means that you were putting out work, you were putting out product, and you are not getting cash for it. But you're expending yourself. So you're doing a service or selling a product, but you're not getting cash for that. But if you have an increase in accounts payable, that means that you are getting some sort of capital or money or like some asset, and and you have to pay it back. But there's still that like increase. It's considered an increase in cash flow because it's like you're getting that now, and that could be like a loan or whatever. And so also just being aware of that too, like, okay, yeah, maybe I got this cash right now, but you know, my cash flow went up, but what's the cost later? Like, I mean, what's the interest rate on this loan, and how am I going to pay that back? And yeah, so that's just what I wanted to add.
No, and you're right. And you'll see that from time to time. Big business and small business are two different animals. You know what I'm saying? Big business
Yeah.
could go and spend $1.5 million worth of equipment, right?
Yep.
And report a loss on that, right? But they have again $1.5 million with construction equipment that they'll actually depreciate over 5-6 years and depreciate the value and get a tax credit on that over
Yep.
that 5-year run, right? So that's much different than a small business. Is that, hey, I bought me a printer, I bought me a laptop and a desk for, I spent $1,000, right? Huge difference,
Yeah.
$1,000 small business to $1.5 million on the equipment. So yes, it is different for every business, especially for the small business owner who's starting off with, pennies on the dollar, trying to put a couple pennies to make a dollar, But again, being responsible, making those educated decisions is going to be detrimental, or it can be detrimental to the business if you don't make the right decision. So that's why you want to gather enough information as possible so you can make an educated decision for your business. Granted, you might sometimes want to make a decision on chance and like, all right, I think I just gotta feel it. It's a gut feeling. You want to go for it. That's okay. But sometimes you want to make those decisions based upon the facts and what's going on. So the more information you have, the better chances you are of making that educated decision, which hopefully will turn positive for your business, But you never know. Look where we're at right now. We're in the COVID situation. Nobody predicted this. Nobody planned for this. Even the Fortune 1000 is like, holy smokes, what's going on? And they're losing hundreds of millions of dollars. Again, so on one end, when those big corporations, they make hundreds of millions of dollars. When things are down, they also lose hundreds of millions of dollars. So it impacts them in a roundabout way. But they typically will just lay off everybody, lay off, 45% of the workforce, save X amount of dollars on salary, and which will get them over the hump. But when you're a small business and you have a crew of 5 guys, laying off 2 or 3 guys is total detrimental to your business because you have that much less workforce. So then you can't even go and win that next contract because you don't got the manpower to even fulfill that contract need. So it's a double-edged sword. It's really tough on small businesses. And that's why having cash flow is so critical. So when COVID hit and those businesses went out of business overnight, they were bound to go out of business anyways. They were not going to make it because they didn't have a good positive cash flow. Their accounts receivable was off. They didn't know exactly where they're at in their cash flow. So when those ones who closed out, they were going to go out of business anyways. It just COVID expedited the process. But there's some businesses that had good positive cash flow, had some assets, whatever, and are weathering the storm because they are able to withstand what's going on. And that's why the PPP loan came into play, as well as the EIDL loan, EIDL loan comes into place. And that's where the government says, hey, we want to offset some of your losses due to the pandemic that we're experiencing, and everybody's having a tough time getting by. So that's where those specialty loans come into play to help. Okay, we want to keep those 3 employers on payroll because we have some small work in the pipeline. So we want to keep them employed in this downtime for when that contract starts next month, they're ready to go. Versus losing those employees, then they lose that contract. That's the whole purpose of the PPP loan, is to keep those individuals employed on the job working so that small business can continue to win work, bid work, win work, produce work.
Did we discuss when you have a small business, you have to consider if it's just you or if you have employees tax-wise? Self-employment tax is one thing when you're by yourself, but if you have employees, you have payroll taxes
Mm-hmm. Yep.
to consider,
that's a whole nother added expense. So yeah,
That's
that's and that's another reason why the PPP loan came out, was because the government realized that these small businesses were not able to cover that. They're in trouble. So they're like, all right, here's a small business loan. Take this loan, pay for your employees, weather the storm, let's get through it. And then in hopes that they are able to win additional work, we find a vaccine or something else changes in the market that will keep them going forward. So that's kind of like what it's about. But at the end of the day, I kind of missed that question that came up. But at the end of the day, those businesses still have to operate. They still got to do their due diligence. You just can't throw up your say, "Hey, COVID hit me and I'm done. I don't know what else to do." No, you got to figure it out. You can't use that as a scapegoat and say I'm done because of COVID. You still got to find ways to. And granted, sometimes COVID hit and it will just take you out because there's nothing else to do, right? I mean, there's those businesses such as the ones in the food industry that there's nothing they can do. That doesn't, no matter how they operate their books, their accounts receivable, the cash flow, they watched it, they monitored it, they know exactly how much money they have. But when something like this hits the market and takes it out, then you just got to realize, you know what? Maybe it's time to go start manufacturing widgets because selling burritos is not happening anymore. And that's where you got to make that educated decision. Like, you know what? I'm not going to be able to get out of this. And you need to know when to say when. And you always have to have the exit strategy on how to get out of the business because it'll take you out. Because if you're going to try to, bet on your heart, your hopes and dreams, you're going to end up broke. You got to base it off of statistical analysis and factual information. Because if you bet on your heart and say, "Oh God, I wish, I hope it's going to happen," you can't take that to the bank. Going back to that, remember that scenario that I gave you, that whole Dumb and Dumber, with that guy has all those IOUs in the briefcase, like all the money's there, it's all IOUs. Well, the bank's not going to take all those IOUs because that's nothing to them. So, and I'm going to end it on that note. We have about 2 minutes left. So any other questions, comments, concerns, feel free to ask. But other than that, we'll probably see you next Wednesday. Right? Daniel?
Thanks, guys.
Thank you.
Daniel, anything else on your end, Daniel? You good?